What rattled Wall Street this week is not a crash, not a recession signal, and not a failure of the economy. It was a sudden fear that a new wave of artificial intelligence tools could disrupt how entire industries make money, and investors reacted fast. On February 3rd, 2026, U.S. stock markets closed sharply lower after an AI developer, Anthropic, unveiled new plugins and automation tools for its Claude cowork system. These tools are designed to perform legal research, sales tasks, marketing work, and data analytics, the exact kinds of services many established software and information companies sell today. Investors interpreted that announcement as a potential threat to long-standing business models. According to Reuters, roughly $285 billion in market value was wiped out across affected sectors during that trading session. Here's how it unfolded. Anthropic's announcement came early in the trading day. The company introduced automation features that aim to act like a digital coworker, software that can draft legal documents, summarize large data sets, assist with compliance research, and handle parts of professional workflows that companies traditionally pay subscription fees for. These kinds of tools were not completely unexpected. The AI industry has been moving in this direction for years, but investors reacted as if the timeline suddenly accelerated. As markets opened, selling pressure hit companies that depend heavily on selling legal databases, analytics platforms, and subscription knowledge services. Thomson Reuters fell about 18% by the close. LegalZoom dropped around 20% in some markets. European firms RELX and Wolters Kluwer declined roughly 14 and 13%. These closing numbers come from official exchange data and reflect end-of-day pricing, not just early swings. The sell-off then spread beyond legal and data companies into broader software, advertising, and some hardware stocks as investors reassessed how exposed the tech sector might be to AI competition. By the end of the day, the S&P 500 was down about 0.84% and the Nasdaq about 1.43%. That is not a historic collapse, but it is a meaningful one-day move tied directly to a single product announcement. Drops of this size after a launch are unusual, which is why analysts described the session as a shock reaction rather than routine volatility. The key point is that markets fell on anticipation, not proof. There is no confirmed evidence that customers are canceling contracts or switching vendors yet. There are no earnings warnings tied to lost revenue. Companies are not reporting immediate contract damage. Investors sold based on the possibility that AI tools could undercut subscription pricing in the future. Several analysts began warning that margins, the profit companies earn on each sale, could face pressure if customers gain cheaper alternatives. But analysts are still debating how fast that shift might happen and how defensible existing companies really are. Why did this announcement hit nerves harder than past AI releases? Because it targeted professional workflows directly tied to recurring revenue. Legal research databases, compliance tools, and analytics platforms rely on subscription models that investors view as stable and predictable. If AI systems can replicate parts of that work at lower cost, even gradually, the perceived safety of those subscriptions weakens. Markets often react most strongly when a supposedly stable revenue stream looks vulnerable. The fear also spread beyond the directly affected companies because modern markets are interconnected. Many technology firms trade as a group inside sector funds and exchange-traded funds. When investors sell those funds, unrelated companies can drop simply because they sit in the same basket. That helps explain why some stocks fell even without obvious exposure to legal or data services. Who benefits if the disruption turns real is still unclear. AI developers and chip makers that supply computing power could gain market share. New entrants could capture customers looking for cheaper automation. At the same time, established firms are not standing still. Many already embed AI into their own platforms and may adapt faster than investors assume. That tension, disruption versus adaptation, is exactly what markets are trying to price in. For Americans, the immediate impact shows up first in investment accounts. Retirement funds, mutual funds, and ETFs that hold software or data companies reflected those losses at the close. That is a visible, same-day effect. In daily life, nothing changes overnight. Customers are not seeing contracts canceled, legal research platforms are still operating, businesses are still buying analytics tools. But if competitive pressure grows, buyers could eventually see cheaper software or faster automation options. Over time, that could shift hiring patterns in industries built around information services. This does not mean AI will instantly replace software companies. It does not mean legacy firms are disappearing. It does not signal a tech crash comparable to past bubbles. What it does show is that investors are recalculating how durable certain business models are in an AI-heavy future. Markets are forward-looking machines. They react to expectations before outcomes arrive. What happens next depends on evidence. If companies issue earnings warnings, lose customers, or announce layoffs tied to AI competition, investors will treat the threat as concrete. If firms quickly release their own competing AI products and defend pricing, confidence could stabilize. Analysts are expected to update forecasts in the coming days. Companies may publish roadmaps to reassure shareholders. Competitors are likely racing to announce rival tools. Continued ETF outflows or sustained selling would signal deeper concern. A rebound would suggest the market sees this as an overreaction. For now, the sell-off looks like a sharp repricing based on fear of disruption rather than confirmed financial damage. It's a reminder that technology markets move not just on what's happening, but on what investors believe might happen next. In simple words, Wall Street saw a glimpse of a future where AI does more professional work, and prices moved instantly to reflect that possibility. The economy did not change overnight, but expectations did. And in financial markets, expectations can move hundreds of billions of dollars in a single day.